Rank 1. Finance student. At a hedge fund, nobody gets fired for losing money. They get fired for losing money the wrong way. There is a right way to lose $18 million before breakfast. It will take you 27 years to learn it. You are 20. GPA 3.5. You're not good enough for Harvard, not bad enough to have had any fun. Finance major at Boston College. In high school, you didn't win the award for coolest. You won most boring. Most kids grow up dreaming about the NBA. You grew up dreaming about hedge funds. You watched Wolf of Wall Street 3 times freshman year and somehow came away thinking it was aspirational. Now you're standing at a podium at a recruitment event organized by the Finance Club, pitching a stock to alumni who manage real money. You've spent 3 weeks on this model. You think it's good. Guy in the second row raises his hand. Marcus. His father's fund manages $17 billion and has a building named after him on this campus. Marcus is wearing a Patek Philippe Nautilus. You are wearing a tie your mother bought at Macy's. Nice tie, not a Patek. He tells you your terminal growth rate is 50 basis points too high. He didn't even need to check your model to know this. He says it the way someone tells you your fly is open. Helpful but devastating. The room moves on. 27 years from now, Marcus will sit across from you at a cafe and tell you the real reason he raised his hand. What he says will make you rethink every year in between. Rank 2. Investment banking analyst. Hedge funds don't hire off the street. They hire from investment banks after someone else has already broken you in. You don't get Goldman. Marcus does. His father is a 17-year client. Nobody says this. Everyone knows. In finance, the things everyone knows and nobody says could fill a textbook that nobody writes. You take the offer from the bank ranked 4th. Signing bonus, $10,000. You pay off 1 semester of loans and feel briefly like someone who has figured something out. Marcus posts his Goldman badge on LinkedIn. 47 likes. You close the app. You open it 11 minutes later. You are not proud of this. Your analyst class starts at 32. By month 6, it is 23. Nobody holds an exit interview. Laptop returned to IT. Badge deactivated by noon. Seamless account closed. First live deal lands in week 3. $2.3 billion acquisition. Industrial conglomerate buying a specialty chemicals manufacturer at a 14% premium. Your VP sends the merger model at 11 p.m. 3 words. Clean this up. 4 of the 7 revenue assumptions use comps from 2019. You flag them? He replies at 1 a.m. The client approved these. Leave it. You leave it. You learn something on that Tuesday at 1 a.m. that nobody taught in school. Accuracy matters less than speed. Speed matters less than not being the person who slows the deal. The hierarchy of values in banking is invisible until you violate it. Nobody hands you a manual. Everybody demonstrates the consequences. 100-hour weeks. Free dinner at your desk after 8 p.m. Always seamless. Always the same 4 restaurants. This is the perk. You start thinking of it as a perk. That is the first thing banking does. It takes something depressing and reclassifies it as compensation. You calculate your hourly rate on a Wednesday in October, around the 78th hour. $23. You have a degree from a school that costs $62,000 a year. The math is not the kind they taught you there. The Uber driver who brought you here this morning made more per hour than you did. You close the spreadsheet. You do not open it again. Marcus gets staffed on a marquee tech IPO at Goldman. Front page of the Financial Times. Your deal closes the same week. Page 9 of Merger Market. 6 sentences. No names. Closing dinner at a steakhouse in Midtown. The MD orders a Brunello that cost $400. You get 1 glass. $400 of wine tastes like wine. You file this information away. Your name is on page 47 of the pitch book. Deal team section. 8-point font. Smaller than the compliance footnote above it. 14 months of your life compressed into a font nobody can read without squinting. Month 14. A recruiter calls. You take it in the fire stairwell because at your bank, taking a recruiter call at your desk is treated roughly like a small act of treason. She says buy side like a password. She names a fund. She mentions in passing that the fund's last 3 senior analysts all left for hedge funds. One runs his own now. You interview on Saturday. They offer before you reach the lobby. You accept in the elevator. You are thinking about the 3 who left for hedge funds. You want to know what they saw. Rank 3, buy-side analyst. The buy-side is where the money actually moves. Sell-side advises. Buy-side decides. You work at an investment firm now. Not a hedge fund, not yet. Your new office has a window. You have not had a window in 2 years. Your PM walks past on the first morning and says, "Find me something." That is the onboarding. The buy side does not do orientation packets. 400 companies screened in month 1. 10Ks on the Metro North. Earnings transcripts at dinner while the food gets cold. Your girlfriend asks what you're reading. Earnings calls. She asks again the next night. Earnings calls. Third week she stops asking. You notice. You don't fix it. You tell yourself you will when things settle. Things at this level do not settle. They just become the new standard you measure suffering against. In 2 years you will not have this girlfriend. You will have a different girlfriend who also stops asking. The pattern is the career. You just don't see it yet. First pitch and Monday meeting. Small cap healthcare. 3 weeks of channel checks, a proprietary survey of 200 physicians, and a reimbursement analysis you finished at 3 a.m. The PM listens for 4 minutes. Pass. No explanation. No follow-up question. In banking, they at least pretended your work had a trajectory. Here, pretending is not in the budget. You pitch again 6 weeks later. Mid-cap software. The street mispriced it because of a restructuring charge buried in the footnotes. Of a 10Q that 90% of analysts never read past the income statement. Normalized earnings 40% above consensus. The PM nods. 15 million goes in. 8 weeks later. Up 22%. At the quarterly review he mentions the software name as a highlight. He does not mention yours. You are the quality of your ideas here. Your name is not the product. This distinction sounds philosophical until someone else gets credit for your work. Then it becomes extremely practical. Your fund manages 800 million. Marcus's fund manages 6 billion. You learn this on a Bloomberg terminal in the break room. The gap is not capital. It is access. His fund gets CEO meetings at investor days. Your fund gets 30-minute callbacks from IR associates reading scripts. Capital attracts access. Access generates returns. Returns attract capital. You are outside that loop. Conference in the fall. Marcus is there, wearing the Patek. He shakes your hand, asks where you ended up. You tell him. He says, "Oh, cool." In finance, "Oh, cool" is the polite version of "I have already ranked you and moved on." He does not ask a follow-up. He crosses the room toward people who outrank you in ways you can feel but not yet name. That night, a headhunter emails, "Multi-manager hedge fund." The name is in the subject line. The analyst next to you on the train sees it on your screen and looks away like he walked in on something. You reply before your stop. Rank 4. Hedge fund analyst. Your sleeve is $40 million. The number is on a screen everyone can see. There is nowhere to hide at a hedge fund. In banking, you could disappear inside a deal team. Here it is, you and a P&L that updates while you sleep. The fund manages $3.2 billion across 14 desks. Bloomberg terminals at $24,000 a year each. When you are up, nobody mentions it. When you are down, nobody mentions it either. The silence means different things depending on the direction. First loss. Week 6. Biotech position misses an FDA advisory committee vote by one panel member. Down 2.8 million in a session. Your PM pulls up your P&L. No emotion. Assessment. He says nothing. The silence costs more than the money. The analysts who blow up are not wrong about the thesis. They are wrong about the sizing. One of your colleagues learns this in your second quarter. He put 6% of his sleeve into a binary FDA event. The science was clear. The committee voted no. He is gone by week 10. His desk is reassigned Monday. By Tuesday, nobody mentions his name. Being right about the idea and wrong about the size is the same as being wrong. Nobody in this building explains this rule. The rule explains itself. 6 weeks later, you find a short, over-levered specialty retailer with 1,300 stores and a debt stack that looks like someone built it during a fever dream. The street loves the top-line revenue growth, but nobody has modeled the debt covenant that matures in 9 months. You go to the footnotes of the 10K page 94, paragraph 3. Build a downside model around the covenant trigger. Stress test 3 refinancing scenarios. None work. The PM gives you the sizing. Stock drops 40% when the breach hits the quarterly filing. P&L for the quarter. Positive 11 million. Bonus at year end. 350,000. You wire half to savings. You buy nothing. The wanting has been replaced by something quieter. Keeping score. Marcus appears in a 13F filing. His fund is on the opposite side of one of your positions. He is long. You are short. One of you is wrong about the next 2 quarters. You start checking his filings weekly. You would not admit this. Your PM takes you to dinner. Just you. He orders without looking at the menu. He says you have good instincts. He says it like a fact. The dinner is the compliment. Year-end review. The PM promotes 2 to senior. You and someone with 13 months more tenure. Sharing a promotion is not the same as receiving one. He calls you into his office 4 months later. Closes the door. He is leaving. He is starting something. Rank 5. Senior analyst. Your allocation is 120 million. 2 junior analysts. Both are hungry the way you were 3 years ago, checking their P&L before their email, staying past midnight to prove something nobody asked them to prove. You teach them what you know. You do not teach them what still scares you. The proxy fight arrives in month 3. Activist fund with a 12% stake demanding 3 board seats at an industrial conglomerate you have covered for 2 years. You size it at 4% of your sleeve, 4.8 million on a thesis. That depends on 7 directors you have never met voting the way you think they should. Your PM raises an eyebrow. Does not override. This is the test. Right means PM track in 18 months. Wrong means you become a cautionary tale at Monday meeting. There is no middle outcome. The CEO goes on CNBC and calls the activist a short-term parasite who doesn't understand the business. The stock rallies 4% on the interview. Your position drops 12% in 8 days. 4.8 million becomes 4.2. Your junior analysts start watching your face the way you used to watch your PMs, looking for panic, looking for a tell. You add to the position. You are not sure if that is conviction or ego. The difference matters. You cannot tell them apart from the inside. Board capitulates 6 weeks later. New CEO. Strategic review. Full return. 38%. Your PM nods at Monday meeting. 1 nod. At this altitude, that is the standing ovation. You buy an Omega Seamaster. $8,200. You could buy the Patek. You don't. The Patek belongs to a story about inheritance and fathers who manage 17 billion. You would rather wear something you chose. Compensation at year-end. 1.2 million. You are 29. Your college roommate texts that he made senior product manager. 280,000. He thinks this is a lot of money. It is a lot of money. You don't share your number. The gap would change the friendship. It already has. You go home for Thanksgiving. Your father asks what a hedge fund actually does. You explain it 3 ways. He nods the same way each time. He is proud of you in a way that has nothing to do with understanding what you do. This is the last kind of pride that feels clean. The PM calls you in on a Thursday in February. He is leaving, raising 500 million for his own fund. Your name is on page 3 of the pitch deck. He didn't ask first. He says he knew the answer. He was right. Rank 6, sector head. The fund launches with 540 million. Your name is on the ADV filing the document that tells regulators who is responsible when things go wrong. It does not feel like a title. It feels like a receipt for something you cannot return. Your sector is technology. 180 million across 12 positions. You hire your first analyst in month 2. She is 24. Contrarian, precise, slightly too certain about everything. At this stage, that is exactly the right flaw. You give her 30 names and tell her to find something. She comes back with a pitch on a semiconductor company. The thesis is wrong. She misread the inventory cycle, but wrong in a way that shows she can think. You tell her to fix the model. You don't tell her how. You remember someone doing this to you. Tech sells off 18% in 6 weeks. NASDAQ drops 400 points. Every name in your portfolio is red. The founder calls on a Tuesday morning. Does not ask how you feel. Does not ask how your team is doing. Asks your conviction level, name by name, ticker by ticker. Then cuts your allocation by 20%. 7-minute phone call. 20% of your capital removed by a man who trusts you enough to give you a 180 million, but not enough to let you keep it when the market coughs. He hangs up. You sit with it. 3 months later, your analyst brings a short. SA-S company with net revenue retention the street adores 138%. Headline number. She found the contract structure underneath. 3-year enterprise ramps that flatter year 1 and reverse hard in year 3. She modeled the reversal quarter by quarter. Nobody else had. You size it. Stock drops 31% on Q3 earnings when retention falls to 104. She is grinning when you pass her desk. You nod. 1 nod. She receives it and understands exactly what it means. The cycle has replicated inside you without asking. Marcus launches his own fund. Bloomberg article. Day 1 AUM. 1.2 billion. Family money, 2 sovereign wealth funds. The endowment your fund pitched and lost. Photograph of him at his desk. Patek on his wrist. You read it twice. Close the tab. The feeling does not close. Year 2. Fund returns 19% net. Your sleeve. 24. The founder puts a GP term sheet on the table between appetizers and the entree. General partner. Real carry. You sign it that week. GP carry means you earn a percentage of profits above the hurdle rate. It also means you cannot leave without forfeiting years of economics. The golden handcuffs in this industry are not metaphorical. They are contractual. And comfortable enough that you don't notice them until you try to stand up. Rank 7. Portfolio manager. You manage 400 million. 6 analysts. 2 sector heads. Your 13F gets dissected quarterly by strangers on financial Twitter who have strong opinions about your position sizing. They don't know your name. They know the funds. The founder talks succession at dinner. He is 52. Wants to step back in 5 years. He says it between the salad and the entree, the way people deliver large decisions when they want them to sound small. The offer is worth roughly 40 million in carry over the next decade. You cut your steak. You say, let's talk about it. You have learned that the pause is worth more than the answer. A pension fund requests a meeting after a difficult quarter. You fly to Hartford. The woman across the table is 51. She manages retirement assets for 40,000 public school teachers. She asks about drawdown recovery and risk attribution. What she is actually asking: will a teacher in Bridgeport not retire on time because of your judgment? You answer every question. You fly home. The money has faces now. Macro call in Q2. Rates going higher than Fed funds futures imply. Cut 3 names that need cheap debt. Add 2 that generate free cash flow in any environment. The Fed raises 50 more than consensus. Your sleeve outperforms the fund by 600 basis points. The founder does not nod. He smiles. You have never seen him smile about performance. You are no longer being evaluated. You are being handed something. Your wife says she does not recognize you during drawdowns. The person who comes home after a down week is not the person she married. You say the pressure is temporary. You have said this 4 quarters in a row. Neither of you comments on the pattern. The pattern is the answer. Capital introduction event in Greenwich. Marcus is there. 2.8 billion now. Wearing the Patek. He buys you a drink without asking what you want. Asks if you've thought about launching your own. You say not yet. He says you should. You cannot tell if that is encouragement or a scoreboard check. That night you open a blank document. Type your name, then capital. Stare at the cursor. Don't write anything. Save the file. Don't delete it. Rank 8. Hedge fund founder. The farewell dinner is 40 people. The founder toasts you as the best investor he ever trained. Not worked with. Trained. You notice the word. It is the last night you will be in a room where someone else's name is on the door. Raising capital takes 5 months and 74 meetings. Zurich, Abu Dhabi, Singapore, Boston, London, New York. Hotel rooms that all look the same. Pitch decks that you have memorized so completely you could deliver them in your sleep. And some mornings, crossing time zones, you nearly do. You sit across from allocators who are 28 years old and have more control over your future than any portfolio manager ever did. 62 say no. Some say not right now, which means no. Some say interesting, which means no. Some say nothing, which also means no. No has approximately 15 dialects in capital allocation. You learn all of them over 5 months and 11 time zones. You launch with 320 million. 3 rooms in Midtown, 7 employees, Bloomberg Terminal. 24,000 a year, same as every desk you have ever sat at. Rent, 38,000 a month. Your anxiety is no longer about positions. It is about payroll. 7 families depend on you before a single trade is placed. Year 1, 16.4% net. Good, not exceptional. Institutions want 2 years of audited track record. They want to watch you lose before they trust you to win. The logic is perverse. You understand it completely. Month 14. Accounting fraud at a 5% position. Revenue recognition manipulated across 6 quarters. You sell everything pre-market, down 18 million by breakfast. You now understand the opening line of this story. There is a right way to lose $18 million. You write a 2-page letter to your LPs. What happened? What you missed? What you changed? No hedging. No minimizing. Facts. 3 LPs call to say the letter is why they are staying. One redeems anyway. The letter cost 40 million in AUM. It saved 280 million. How you lose matters more than how you win. You knew this as a concept. Now you know it as scar tissue. Marcus's fund is in trouble. You hear it the way everyone hears it, a rumor at dinner, a number on a Bloomberg chat, a source who says don't repeat this. Down 23%, redemptions accelerating, 1.2 billion down to 800 million and falling. The system that elevated him does not care about his name. It never did. You just couldn't see that from where you were standing. Year 3. 780 million. Net return, 22%. An endowment allocator, 31 years old, asks across a conference table. What makes you different from every other manager with a good 3-year run? You have 4 seconds. What you say determines whether you manage 1 billion or 10. Rank 9. Billionaire. Your fund manages $12.4 billion. 68 employees. Greenwich office with a view of the water. Art on the walls your COO selected. You don't know the artists. You know the prices. You have not personally built a financial model in 4 years. The thing you were best at, the thing that got you here, you no longer do. You sometimes open Excel to remember what it felt like. You close it after a minute. The spreadsheet is empty. So is the feeling. Net worth crossed $1 billion on a Tuesday in November. Your family office manager reported it like weather. You told your wife at dinner. She said, "That's great, honey," and passed the salad. $1 billion and she passed the salad. You still check restaurant prices before ordering. Discipline or damage? You are not sure which. Davos, panels, central bankers who know your name. Your opinion on rates is quoted in the Financial Times. You read the quote. It sounds smarter than what you actually said. You are becoming a character based on yourself. The character is more certain than you are. Your son is 14. He asks what you do. You say, "I manage money." He says, "Like a bank." You say, "Sort of." The real answer, "I bet on things," and the bets got large enough to become buildings and salaries and obligations, is not something that sounds like it should be a job. A sovereign wealth fund allocates 800 million in a single ticket, largest in your fund's history. The CIO says across a private dinner, "We are betting on you personally. You fly home. 800 million of a nation's wealth index to your judgment. You used to lose sleep over 40 million. You should lose sleep over this. You don't. That is the part that frightens you." Marcus calls. First time in 3 years. His fund closed. 1.2 billion to 800 million to 400 million to liquidation. He is consulting now. Asks to meet for coffee. Cafe in Greenwich. He is wearing the Patek. He looks older. Talks about the next chapter. After a while, he pauses. Says, "You remember that pitch competition?" You say yes. He says, "Your terminal growth rate was fine. I just wanted the room to see me. 27 years. That is how long that correction took." You pick up the check, $22. 27 years compressed into a tab smaller than the seamless dinners you used to eat at your desk at 9 p.m. on a Tuesday. Your daughter texts that evening. 3 words. "Proud of you, Dad." You type "thank you." Delete it. Type "love you." Send it. The most honest thing you've said all quarter. Somewhere tonight, in a library at 1 a.m., a 20-year-old is building a DCF model on an obscure company nobody covers. Her thesis is contrarian. She has a plan. 2 years in banking. Lateral to buy side. Get inside a fund. Build something with her name on it. She bookmarks a profile of a fund manager who runs 12.4 billion out of Greenwich. She doesn't know his name yet. She will. The machine doesn't care if she's ready. It just needs new parts. If this one stayed with you, like and drop a comment with where you're watching from. Subscribe for more.